There is a massive, massive advantage Canadian listed ETFs have over US listed ETFs, and I don't think this is talked about much. It's fairly a new phenomenon, a fairly newer type or style of ETF, but it's something that actually does not exist on the US stock market yet. In a certain form, it does, but on the Canadian stock market, now we have this attribute for growth ETFs, dividend ETFs, and covered call income ETFs. Of course, I'm talking about 25% leverage versions of ETFs. So, guys, I think I gotta make this video because it's very, very important. If you're an investor, and I don't care whether if you're a long-term investor, and I don't care whether you're a growth investor that invests in passive index funds, you're a dividend investor that invests in dividend stock ETFs, or you're an income investor like myself that invests primarily in covered call ETFs, there's a particular attribute which will help your long-term growth, your long-term yield, everything. Let's just call it long-term performance of each one of these particular style ETFs over the long term. That's leverage. And 25% leverage is really a really nice amount that's modest, it's light, and I'm going to tell you why I think it makes a big, big difference. It's actually pretty simple to understand. First of all, let's go through what is, when an ETF is leveraged 25%, what does that mean? Well, it actually means that basically the fund manager, the ETF manager, will borrow 25% of the fund's assets to invest more in the particular ETF, 25% more. So another way you could think about it is you're borrowing money to get 125% of the performance of the particular ETF, good or bad, right? But if we're talking about investors who invest in quality assets and we're holding them for the long term, like an S&P 500, Canadian dividend stocks, covered call index-based covered call ETFs that are index-based like S&P or NASDAQ, or something like an XEQT, VEQT, ZEQT, which basically just says, just give me all the best stocks all around the world. We all have to admit to ourselves that over the long term, 5, 10, 15 plus years, all these assets and ETFs go up over time. So, of course, and this is why a lot of people borrow money or take margin to increase that growth. The problem is, number one is me and you can't really get really good rates. Number two, it could be scary because you could get margin called if you take too much leverage. So I feel that these 25% leverage version ETFs, and we're going to take a look at a bunch of examples shortly, and I'm going to show you growth oriented ones, dividend oriented ones, and of course covered call income oriented ones. They all three now exist on the Canadian market. On the US market, that does not exist. So 25% leverage will basically increase the performance 25% over time minus borrowing costs, leverage costs. So what these ETF fund managers are doing is they're borrowing money and they're enhancing. That's why there's typically the word enhanced in all these ETF names, the performance of the fund 25%. Now, this can mean 25% more volatility, of course, 25% more downside during bad times, like the market is going through now, a little bit more volatile. But we're long-term investors. We don't really care about month to month, week to week, quarter to quarter. We care about 3, 5 plus 10 years. So, of course, it makes sense that you'll always do good and better if you have 25% enhancement. Another good thing to think about is that interest rates are very low. I think they're going to be low for a really, really long time. We saw that just increasing them to like 5% caused chaos. I don't think we're ever going to have a period, this is my personal opinion, of high interest rates in the future, like at 7, 8, 9, 10, which won't really make sense borrowing money at 8, 9, 10, 11% interest to invest, for example, in the S&P 500. And S&P 500 typically returns 11, 12% a year on average. So if you're borrowing at 10%, it could still make sense. You still have like 2% of margin. But interest rates in Canada now, it's even cheaper than the US. It's under 4%. I don't even know what it's at now, 3%, something like that. So if you're borrowing at about 3.5%, and your ETF is making on average 11, 10, 12% return, it makes sense. You have enough margin, you have enough wiggle room to make it worth it. So this is leverage that the fund managers are managing themselves. That's another thing. You don't have to worry about it. They get the best rates. You don't have to worry about margin call. It's already integrated in the ETFs. But of course, you will see higher MERs, management expense ratios, of all these enhanced and leverage ETFs, because leverage costs are going to be included in the MER. So you'll see MERs of 2.5, sometimes 3%. That might seem crazy, but that's because they include leverage costs. The key is always to look at the performance. Always look at the performance. And now there's been more and more years. There's some that have been out for a couple of years. These are relatively new, so we don't have too much performance data. But I could give you a few examples. So first of all, let's look at a few ETFs here on the Canadian stock market that are leveraged very modestly, 25%. We'll start with growth ETF first, guys, okay? So no covered call ones. Let's start with the growth ones. And of course, when we're talking about growth, index-based ETFs come to mind, right? S&P, NASDAQ, TSX 60, the whole world. So the fund manager in Canada that has the most comprehensive lineup, and I would say this is pretty much the only fund manager who has right now these 25% leverage growth ETFs, no covered calls again here, is Global X Canada. If you click on our ETFs, you actually search for enhanced, because like I said, find these are very easy typically. They have enhanced in the title. You'll get all the 25% leveraged versions of these ETFs. Again, this is 25% leverage, which is 1.25x. These are not the same as those crazy 2x, 3x leverage ETFs in the US, by the way. That's 200, 300%. And those are meant to day trade. These are meant for investors. I only cover investing stuff here, right? Long-term investing. So if you just type in enhanced, you do a search, you'll get all of their leverage, it's all 25% leverage. They have leverage covered call ETFs, leveraged asset allocation ETFs, leveraged growth ETFs, and you could kind of really tell by the name. They have all the indexes you could ever want. Let's just go through a bunch of popular ones for growth, guys. USSL is simply the S&P 500 with 25% leverage. That's all it is. It's pure index with 25% leverage. It's not even a year it's been out yet. The management fee is 35 basis points. The MER is not out yet because it hasn't been a year, but it's going to be something like 2% plus because leverage costs are included. And remember, leverage costs are really associated with the interest rate. So the lower the interest rate is, the lower the leverage cost, the better it is. So this is a fairly newer ETF. There's only $6.7 million in assets. What could we really compare this one to? Well, Global X actually has a USSX, I believe, which is a non-leverage version. If we actually click on the holdings of what's inside USSL, it's basically 125% of the Global X S&P 500 index ETF, which I'm pretty sure is USSX, right? So it's just USSX or the S&P 500 with 25% leverage. Another one, we could compare this to VFV. VFV is the most held S&P 500 index ETF in Canada. USSL is basically VFV with 25% leverage. So obviously, if you're going to hold the S&P 500 over 5, 10, 15, 20 years, having 25% leverage is going to automatically give you increased performance. Is it going to give you 25% increased performance? No, it's going to be 25% minus the leverage cost, but it always will give you higher performance if over time the market goes up, which we know it does. And I'll give you some some performance examples soon because there's not many that have been out for a year yet. Here's another example for the NASDAQ. Global X has QQQL, which literally is 25% leverage version of the NASDAQ 100 index. We could compare it to something like QQC. In the US, it's QQQ. In Canada, Invesco, the Invesco NASDAQ 100 index is QQC. So instead of getting this, or ZNQ, BMO has one called ZNQ, I believe, for the NASDAQ 100. And you're going to hold something, you're going to hold something for 5+ years, you might as well get the leverage version. right? Again, this is just 25% more performance over time. Same thing for the TSX 60 index, which would be like an XIU. They have CAN-L, the S&P TSX 60 index ETF enhanced, right? So I'm going on and on here, but I'm just going to show you more examples of really the classic index funds that people hold. So they have an S&P one, they have a NASDAQ one, they have a TSX 60 one. They also have one for people who really like the XEQT ETF, which is similar to VEQT, FEQT, HEQT, right? This is basically in Canada, these ETFs hold a combination of index funds that gives you access to all the best stock markets, the best stocks all around the world. They have one for that as well, the HEQL, which is the Global X Enhanced, there's that enhanced again, All Equity Asset Allocation ETF. What's inside? 125% exposure to their HEQT ETF. So it's like getting something like XEQT with 25% leverage. And this one's actually been out for over a year. So why don't we look at the performance of HEQL versus XEQT? 1 year performance, 21.53. 1 year performance of HEQL, the leverage version, 24.79. Remember, guys, the ultimate truth for any ETF to figure out how good it is the performance. It's not the management fee. It's not the MER. The performance, this what you're seeing here, this is net. This is after the management fees, after the MER. So obviously, if the markets do well, and as we know, especially in the last year, the markets have done really well, you're just going to get higher performance in the non-leveraged version. So this is for growth ETFs, guys. This is if you're an index growth ETF. There's Global X has basically all the options. They have other ones as well, including one for emerging markets. They have a covered call one and a non-covered call one. One for EAFE, right? Europe Far East as well. It would be EAFL. It would be EMML for the emerging markets one. So you got all your indexes covered and you got the whole world covered with HEQL. Even if you're a dividend investor, you know that in terms of being a dividend investor, one of the most popular ETFs is VDY. A lot of people love VDY to get Canadian dividend stocks. So the VDY is a Vanguard Canadian listed ETF that invests in Canadian dividend stocks. The US equivalent would be VGG, very popular. This is still listed in Canada. It's a Canadian ETF, but it invests in US dividend companies. Well, Hamilton ETFs now have the first dividends specifically for dividend stocks, 25% leverage versions for Canada and the US. So the Canadian ETF is called CWIN. So this is an ETF that holds Canadian champion stocks or Canadian aristocrat stocks, so Canadian dividend stocks that grow their dividend over time, which is what a dividend investor wants, with 25% leverage, right? It basically holds the non-leverage version. They have a very interesting graph here to show what this ETF could have done in the last 10, 15 years versus the same thing but without the leverage. So obviously, if dividend stocks go up over time, if you have a little bit of leverage, you're going to get more return. You could see that the total return is much higher than the non-leverage version. And by the way, CWIN is simply a 25% leverage version of CNVP. That's why when you look at what it actually holds, it's 125% of CNVP. They have the exact same thing on the US for US dividend stocks, SWIN. Same concept, it holds 125% exposure to SMVP, which is US dividend stocks, right? So if you go down, you could see it's all the amazing US dividend stocks that you could expect, but it has 125% approximately of SMVP. So if you want to actually check out the entire stocks, the breakdown, you got to go to the SMVP ETF. I won't do that now, but again, if you look at the graph, it shows you that over time you're going to get a much higher return in performance with the non-leverage version. So again, these are dividend focused ETFs with 25% leverage. So now you have actually, I would say, my opinion, better version of VDY and VGG if you really like dividend stocks. And then, of course, in the covered call income space, there's a bunch of them, right? Global X has enhanced S&P 500 covered call ETF, USCL. And if we just, by the way, compare the leveraged version to the non-leveraged version, same thing, S&P 500 with covered calls, no leverage, 1 year performance, 23.59. The leveraged version, 28.14. Of course, if the market does really well, that also helps. And again, I will reiterate the fact that if the market does bad, you're also going to do 25% more bad. But again, you got to, as an investor, you're long-term thinking, not short-term thinking. So here's an S&P 500 enhanced covered call ETF. They have a NASDAQ one again, QQCL, that's a NASDAQ 100 one. The whole world, which is this, is basically the covered call version of this, of HEQL. So it's 25% leverage, but it has 25% leverage and the covered calls, right, with a 12% yield. There's HYLD, they're also from Hamilton, HDIF from Hamilton, HDIF, HBIE, BMAX. These are all 25% leveraged or more. BMAX has 33. It's the only one that has 33. But these are all 25% leveraged covered call ETFs, which I talk about in detail in this video, the Grade 8. Very, very popular, important video to really, I show you the top 8, soon to be 9, leveraged, and again, modestly, lightly leveraged, 25% covered call ETFs. So there you have it, everyone. Whether you're a growth investor, dividend investor now, or a covered call income investor, the Canadian market is amazing because we have basically almost everything 25% leverage versions. And again, it's a small amount of leverage. It's not that crazy amount. It's a nice and small amount, but it gives you a nice 25% approximate boost over time in performance. This is hands-off leverage. You're never going to get margin called. And it's managed by the fund managers who are big institutions that get the best interest rates. To me, I cannot see, if you're an investor, long-term investor, whether you're growth, dividend, or income style, that you would not choose to have 25% leveraged ETFs instead of the non-leveraged ones. I just can't see any reason if you're going to be holding these for a very, very long time. I actually talked about it with Brandon Beavis on his channel, and I asked him, why are you holding ZEQT? Why don't you just get HEQL? You'll get 25% over time. So it's something you've got to consider. I would greatly consider, especially if you're an investor that's in it for the long term. And of course, the younger you are, the more benefit this 25% leverage is. I think interest rates are going to stay pretty low for the foreseeable future, if not forever, right? Because they can't raise, they raised them to 5% and all hell was breaking loose. They started bringing them down. I don't think we're ever going to get a period like the 70s or 80s where we had like 8, 9, 10 plus interest rates. I think those days are long gone. So might as well take advantage of low borrowing costs, which you're not even doing, the fund manager is doing, right? So 25% leverage is not a lot, guys. It's like getting a $250,000 mortgage on a $1 million house, basically. It's not a risky proposition, especially if you're just getting a leveraged S&P 500 or NASDAQ 100 or whole world or top quality dividend stocks. You're just going to get more yield, more performance over the long term. Yes, 25% more volatility, but that's something you should be able to stomach as a long-term investor. So I had to make this video because it's a massive advantage the Canadian ETF market has over the US market. These things just don't exist on the US. They have 2x, 3x, crazy 200, 300% leverage stuff reset daily using swaps and things like that. They're not actually borrowing the money. It's just a bit weirder. It's a bit more complicated. That's a lot more dangerous. It's not in the same ballpark. Those are designed for traders, day traders. This 25% classic leverage, I call it, just borrowing money, this is best used for the long term. You'll just get approximately 25% more performance minus the leverage costs, which are pretty damn low in this day and age. So give me a thumbs up, guys. I hope this video was informative for you. Again, Global X for the growth ones. You got Hamilton for the dividend ones. Those are really the only ones for growth and dividend. For the covered call, Almost all of them have enhanced versions, and hopefully there's more enhanced 25% leverage versions coming out for growth and by other providers on the Canadian market. It's pretty popular. It's a great idea, and I highly recommend you think about it. So take care, everyone. See you next time.